Good afternoon, everybody, and welcome to today's edition of Live Market Analysis covering indices, commodities, foreign exchange, and crypto. My name is Carl Capolingua. I'm the market analyst over here at Think Markets Australia, and it is a pleasure to be joining with you as we go macro, we go big picture, and try and figure out what's going on in the world of finance and how that might impact your portfolio. Pretty simple agenda today. There it is. Ask me anything. Q&A window from those various asset classes. I'll give you my best technical and fundamental analysis where available. Before we head to the charts and get your requests rolling in, whether you're watching me on any of the streaming services, there'll be a chat window there where you can do that, or you're live with me in the Zoom session. I wanted to start here. Why? Well, because it's the most obvious place to start. Markets stringing together a couple of days of gains, and even up until JP, he started speaking and broke the market again, didn't he? It all unraveled as a result of that his press conference held after the meeting. And I'll give you some words here that he said. Central banks expecting slower growth. That's not exactly good for the stock market, is it? A decline in inflation, well, we like that, but only a gradual decline, and the rebalancing of both supply and demand within the labour market. So weaker labour market, more people unemployed. So 3 crosses for the stock market. And then saying that this is their most likely case. If that happens, participants don't see rate cuts this year. So saying, yep, things could get worse with the economy. Inflation is only going to gradually decline, and probably no rate cuts this year. And that is completely at odds with what the market was expecting. Markets were expecting rate cuts later this year. Some of them were even hoping for a pause in the current meeting. So what I've got on screen, I know it's a little bit ugly, but it is showing you going forward now as a result of what happened last night in the US, where we're sitting for future rate meetings. So the next one is these are US dates. So we've got month first and then a day of the month. So the next meeting is on the 3rd of May, and we're roughly 50-50, let's call it, for a pause or a cut. So think about where the markets are positioned. It's actually slightly skewed towards a 25 basis point. In fact, that's not true, because that's where we are now. So 56% for a pause and 43% for a further rate hike, I should say. And then we're going, it changes because some of the probabilities are going to change, but we're then skewing more towards a pause in June, and then we're starting to grow the case, but not decisively, for rate hikes from there. So it was this idea that we will not get those cuts later this year is what broke the market. Here's the Fed dot plot. So we can see that for much of 2023, we should be expecting rates around about 5%. That's the median here. And then for 2024, that could come down to around about 4%, and just keeping the numbers around 2025 around 3%. And it's not until we get to the longer run, whatever that is, that we're coming down to sort of a balance point of around about 2.5%. So if we head over here now and have a look at the charts and see what havoc that wreaked on markets. Well, hey, we've got gold on screen, not a terrible place to start. We might as well start here. By the way, I should mention Khan from Think Markets customer support is online and ready to answer any of your questions in the chat window. So we'll kick off with gold here, and we can see that we do have a long-term uptrend. I might just flick over, if you'll allow me to come here, because I've got my scratchings on here. The first thing I'll do is highlight the demand and supply side buddies. Fortunately, I've got them drawn on screen because I have to draw them every webinar we do, because they're so important. And I do believe repetition is the mother of all learning. So if you're learning technical analysis, you absolutely must know these candlestick patterns. Now, there are hundreds of candlestick patterns. I've got books on my shelf. I wish I could turn this camera around, because I'd be able to show you my bookshelf, where I've got, dozens of Japanese candlesticks books. But really, and I have been studying them for over 20 years. I was studying Japanese candlesticks before YouTube existed, okay? Before TikTok existed. Trust me on that one. And in my extensive experience on using these tools, I can say with absolute certainty, they are brilliant. you must know how to use them. If you're managing your money, you need to know Japanese candlesticks. Hey, there's a reason why they've been around for 300 odd years. The second thing is most of the patterns, I wouldn't say are completely useless, but are absolutely redundant, because when you boil those patterns down, when you blend the candles together, you either get one of two patterns, and that is something which is signaling a transition from one trend to the other, and that is the first candle here, this first black candle, and this fourth white candle here. Okay, this is a transition. So if I label them, let's go 1, I have to go space, 2, 3 and 4. I know we should be talking about gold, but let me just say this first. Candle 1 is a transition from a state of excess demand to the potential commencement of a state of excess supply. And anytime you do technical analysis, you must boil whatever indicator that is on the screen, all your squiggly lines. I know how people who get into the markets, get into TA, they start following these quote unquote technical analysis experts on TikTok or YouTube. And I tell you what, those people just read a couple of books and they're just spouting you the same stuff verbatim they read in those books. When you learn how to do it properly, you will learn that there are really two types of things that go on the market. And it all comes back to demand and supply. Either we're in trend or we're changing that trend. Okay, and candlesticks are a great example of that. Candle 1, we are going from a state of excess demand to potentially a state of excess supply. Candle 2, we are in a state of excess supply. Candle 3, we are in a state of excess demand. And candle 4, we are transitioning from a state of excess supply to potentially a state of excess demand. Everything in TA must be boiled down to demand and supply, because they are the two key forces which drive price. And if it's your job as an analyst to your job as an analyst is to figure out where the price is more likely to be next day, next week, next month, whatever it is. And that's only through doing that can you possibly hope to profit in the markets in the long run. I got a little bit excited there, I think. So let us go back to gold and talk about some of these candles now in practice, now that we know exactly what they are. So we can see one of these candles here. Look, I can't make this stuff up, can I really? Let me talk about this one here. So we're talking about this candle here, and we can see how it does signal that transition between a state of excess supply into what actually becomes a state of excess demand. So I'm not making this stuff up. Let me get rid of that because I don't like it. I'm going to draw it again because I want it to be red and I want it to be solid light. There we go. That's the one there. Now note, does this work 100% of the time? Look, candles come in on a daily basis. We get candles all the time. It didn't quite work there. I wouldn't say it was completely awful there. In fact, it did show that we were trying to find some demand in here. We just found more supply, didn't we? We're still in that trend. We get this candle here, one reversal, I should say, one transition candle from excess supply to demand does not a reversal make. We need some confirmation. Even better, we push up some great candles demand coming in here, and that demand gets tested. The metal of that demand gets tested. Are you guys really coming back into the market? Yes, we are. In fact, we're coming back in a big way. We take out that point of supply there. And really, this candle here is the key signal on this chart. Okay, I wish I could rewind us back to that day and say, this is what we need to do. But we weren't there. Okay, we're here now, and we're going to learn for next time. That's the key candle on that chart. And we can see that obviously it's holding 2 times on that long-term uptrend, the dynamic trend zone. Where are we now? That's history. Where are we now? Okay, well, we do have some supply in the system. And lo and behold, there we are looking at that candle, which represents a potential transition from a state of excess demand to a potential state of excess supply. Note there's a little lower shadow there. It wasn't totally convincing, but I tell you what, that's pretty convincing. What's confusing is you don't often, hey, it can happen, but you don't often get black, white, big exhibitions of excess supply and then big exhibitions of excess demand. You wouldn't think that would be the case, just thinking about it from a logical perspective. But it can happen. I think last night's candle wasn't totally convincing. Firstly, we did not totally eclipse the supply that is evident in the system from the previous black candle. We closed off the highs. So whilst I see plenty of good stuff going on here in the gold chart, short-term trend is up, long-term trend is up, I would suggest that if we cannot get above that high there, and I'm going to give you a number, hover over it. That high is 1985. If we can't close above that tonight in the US, obviously I'm speaking to you from Australia, or the next session. So we're talking about the 23 March candle, the 24 March candle, then I would start to grow concerned that we're going to be more in a pattern that would start to do this. And if we break beneath that trough low, and I'll give you a number, a close beneath 1934, it's going to start to see us come back down and probe into the short-term value zone, which will start to be rising. And I'll draw X marks the spot here. It's in that. That's not what's supposed to happen. It's in this zone here, eventually, that I would start to look for these candles here. Okay, so these demand side buddies in the green zone is where I would look very, very favorably on adding some risk to this establishing short and long-term trend in gold. Until then, based upon last night's candle, it's not strong enough for me to say I'm rushing out to buy gold now, but it's certainly on my watch list for a potential long. Now, extrapolate that back to any of your gold stocks that you might own in your portfolio, or do the sensible thing, in my opinion, which is get your mind off trading. Gold's going up. I've got to, what stock should I buy? What gold stock should I buy? I think that is a really faulty piece of logic. And I think what you can do is, if you think gold's going up, just buy gold. And that's evidence, the ability to do that is evidence on screen here. So this is our Think Markets trading platform. So it's called Think Trader, web-based platform. So you can see I'm using it on my desktop. And these are all CFD instruments, so contracts for difference. I don't need to worry about owning the underlying shares. It's not important. All I care about is trading the difference in the trade. So if I buy something at $1 and it goes up to $2, I'm going to get that dollar profit for however many times the asset I bought. Okay, that's all I care about. If it goes down, then I'm up for the difference as well. Okay, so I would just literally find XAU USD. XAU is obviously the symbol for gold, and then USD is trading against the US dollar. I click on the trade window. I come in here and I decide, most importantly, how much I want to trade. And this is a micro contract. This is a very small contract. So if you wanted to trade gold on the gold futures contracts, you're going to need thousands of dollars US for your margins. Here, I can do it for as little as 146 bucks. And if I'm not sure how it all works, I can literally just click on this. And let's say we're at 1971.45, give or take. If the price goes to 1981.45, give or take, I'm going to make about 15 bucks. Okay, so and that's Australian, by the way, because my account's denominated in Australian dollars. So if gold goes up about $10, it's worth about US $10, isn't it, to me? And therefore about $15 Australian. And if I've got a view that gold is going to go to, say, 2065, just under the last major swing high, we'll look at the chart in a second, then I might think, well, I'm going to make 139 bucks. And if I go back to the chart and find, let me find for you a reasonable stop loss, will depend on what the candle's printing there, but probably around about that 1879 level, just getting in underneath 1880. And this is purely hypothetical here because we don't know what our entry point is actually going to be. But I'm just trying to give you an idea on how it fits together. And we're going to go back here. Sorry. So let's say 1979. Let's say we'll just set up, well, that we can't do it because it's above the price. So let's go 1969 just to show you how it would work. Well, in this case, if I was to go long right here, it'd be a $3 loss for $130 odd profit. So pretty simple. If you think gold's going up, stop mucking around with stuff like this, and I know you say, oh, well, it has gone up a little bit, but look at the downtrend here. One of favorite Australian gold stocks, and gold has gone vertically up and it just really hasn't rallied at all. Why? Because the cost base to produce gold at these gold miners continues to rise and rise and rise, and therefore their profits are suffering, and stock prices are a reflection of profits. Just go straight to the source. Okay, I want to get into some of the questions we've got coming through today. Well, there you go. I've got Louise Bedford is on board. I can't believe it. I'm literally blushing at the moment because I'm so excited to have Louise on board. So I'm talking about candlesticks. Louise is the queen of candlesticks. Go check out her many books and writings on that. So welcome, Louise, and honoured and flattered that you'll join us today. I've got Leonardo saying rate cuts were wishful thinking until inflation falls significantly. Same here in Australia. I think they were wishful thinking, but really all that JP's done last night is confirm his intent to fight inflation over anything bad that might happen in the US economy and with their banking crisis. And the other thing he said, which is actually concerning for investors, but should be reassuring, is the US banking system is rock solid and will do whatever it takes really to keep it that way. But that's not what markets want to hear. Markets want to hear, no, we're going to swing back to doves, and markets didn't get that. Would it be good to cover CFDs in more detail? We think markets. We've got a webinar coming up. Great segue there from MJS booth. It's on the website, and I'll just show you where you can find it very quickly. And I probably should have queued this up before, but head to the website, and Khan and Nick, who's not online today, but they will be hosting a how-to and everything you need to know about ThinkTrader Web, the platform, the products on there, how to set up trades, how to manage your risk, how to set stop losses, how to trial stop losses, and all of that stuff. And just head over to our webinar section in the Think Markets website there and click on register to do that for you, MJS booth. From Josh, there's no Japanese candlesticks in Trading View. I can actually the same. No, of course there are candlesticks in Trading View, and I can prove it to you because that's Trading View right there, Josh. So definitely we've got candlesticks, and that would be my preferred way of looking at it. If you're wondering what else I've got on screen, so I've got my 21 and 34 exponential moving averages. They do form a ribbon because I've done some programming on that, and there's a traffic light system there. We're green obviously for up, amber is we're not sure, and then it goes to pink for down, and a little bit darker for the long-term system, which is 144 and 233. Why those moving averages? I just find they work the best across many instruments over many timeframes, and you can even go into lower periodicities, and they happen to be Fibonacci numbers as well. How about that? Okay, so let us get back to some of these questions now, and we do have QQQ for Damien. Now, I won't specifically do the QQQs, Damien, if you'll indulge me. And if people are wondering what the QQQs are for completeness, let's head over here and go QQQ. And hopefully, if I click that, I might have a chance of finding it. Not going to let me. Yeah, it is a stock. It should be in there. QQQ. Anyway, it's the NASADAQ ETF. Okay, so for whatever reason, I'm not finding in there, but I'm not going to waste any more time. I always say that, and I think if I just look more closely, I'll find it. QQQ on QQ. No, I'm not going to find it. Anyway, I'm going to go to the NASDAQ. Let's do that instead. So let's head over here. And we were talking obviously about markets were disappointed. How did that manifest itself in prices? We can see that we got off to a pretty good start, didn't we? At the beginning of the session last night in the US, it was more of sort of here we go. Jay Powell's going to do us a solid, and then he didn't, and it was like, oh no, we don't. And the worst thing about that candle, and there's so many worse things about this candle. First of all, we made a new high, okay, and then we closed on the low. Our range of the candle exceeded the previous day's candle. The previous day's candle was actually really good. I mean, it gapped up. Nothing speaks more of excess demand than a gap up. So, and then it closed pretty much near the high, a little lower shadow. Yesterday's candle was good. There was plenty of demand in the system. There was plenty of demand at the start of the session last night. Where did that demand go? Now, don't forget what demand is. Demand is cash. Demand is money trying to buy stocks. Cash is safety. Stocks are risk. This is the way you need to think about markets. Cash represents safety. Stick it under your bed, sit on your mattress with a shotgun, if that makes you feel good. But it's safety. Stocks are a giant ball of risk. That's okay, because they also come with reward. They come with the ability for some stocks, no matter what the economic conditions are, some stocks are still going to make money. That's brilliant, okay? On average, in general, stocks over the very, very long run will make you more money than any other asset class. And somebody's going to shout out, hey, crypto or whatever. I don't know. But that's what they tell me, right? So we had people throwing money, okay, to get at the market to get risk, even at the start of the session. What happened? All that money, was absorbed by all that risk and people offloading risk effectively. So people said, no, I don't want this risk. I'll take your money. Actually, I really don't want this risk. I'll take your money. I'll take your money. I'll take your money. And the people who were demanding backed away during the session. They said, okay, well, actually, we changed our minds. All right. We don't want to demand anymore. But hey, look, if you're going to sell it to us at lower prices, then we'll buy a bit down here. Oh, well, it looks like we've got some. Okay, well, I actually don't want to buy any more. Oh, you're going to lower your price. Okay, look, I'll buy a bit down here. Geez, you really want to get out. You really keep lowering your prices to the point where demand just said, look, I'm just getting out of the way of this. I don't want to be involved. How do you know demand got out of the way and said, look, I just don't want to be involved? Because we closed on the low. You know how the NYSE works. Ding, 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 ding. Demand ran away, and all we were left with was a wall of supply. People with stock saying, get me the hell out. I don't want this risk anymore. It's really bad. So what does that mean for tonight's candle in the US? Does it guarantee? I mean, I've just painted such a horrible picture, haven't I? Does that guarantee then that we see something that what I guarantee won't look like that, but it will look more like this in a second? Does that mean we get something like that? And just as I draw on it, sort of it appears, right? It materializes. Hopefully your brain looks at that and says, you know what? Yeah, that actually makes sense. I've seen that before, Carl. I've seen that candle followed by that candle so many times. I actually didn't realize it until you pointed it out. But yes, that black candle follows that candle very, very often. And that's what I love about candlesticks. They're just pictures that our brain can identify really quick and interpret really quick. Okay, go and try and analyze the future earnings per share for the S&P 500 or the NASDAQ, and that would take a very long time. So this is an absolute possibility, okay, but it is not guaranteed. Okay, I can say there's a high probability of this occurring in my experience. I can't give you the exact stats. Okay, I wouldn't propose that I even could, but in my experience, that's the sort of candle that we tend to get. Now, is it possible that we get actually not that candle, but instead we get this candle here? Okay, so just think about this and how many times you've seen this before. Okay, is that possible? Of course it's possible. Anything's possible. Newsflash, you can't see the future. I can't see the future. No one knows what's going to happen next. If you could see the future, you wouldn't be listening to me right now. And if I could see the future, I wouldn't be talking to you right now. That is possible, okay? But it's not probable, okay? I think the higher probability sits with something that looks more like that. And it could be a variation thereof. And hopefully it's not that bad, okay? Because I don't want to see stocks get wiped out, okay? But that is probably the more likely scenario given the indication that we've got from demand and supply last night. The other problem we've got here is obviously the trend. So, we've probably done it the wrong way. We've focused on candles, and candles are really sort of, blow by blow. And where we really should start is by zooming out. Okay, so what is the overall trend first? Okay, and clearly it's still down. The traffic light system is pretty clear there that we are in a dark pink zone in a well-established bear market trend that has been in place since about May 2022. But we can also see how clearly these trend ribbons work. Okay, so if we go back, we can see very clearly green is good, green is go. Amber means something's not right. And you can see how the short-term trends go to amber far quickly, is that right? Faster than the long-term trend. So they're giving you that early warning system. Something's not right. Plus then look at the candles. right? Something's definitely not right. And then look at this two pattern here. And we talked earlier on about the two types of candles, didn't we? We said well, there's one type of black candle which is really sort of saying that we're in a state of excess demand, and then we're in another candle that's saying there's a potential transition here going from a state of excess demand. Did I say that? Excess supply, I should say, that we're potentially going from excess supply into excess demand. But you can see that transition actually failed, didn't it? You can see it failed, and this is another bearish day. And this is a great example of, as bearish as these three candles are, anything can happen, but the trend here is turning. So we've talked about actually trends first, and then the next thing I'm going to look at is what I call price action. And here, this is where everything sort of comes together. Those moving averages, they're sort of longer term, price action's more medium term, and the candles are really short term, blow by blow. But you can see how supply is shifting. The balance, that's not right. Supply's not shifting, but it's the balance. It's the balance between demand supply. It is shifting. You can see some demand points down here. So we've got pods down here. Where we've had pods in the past, we really should expect to have pods in the future. Did we get a pod in the future? No, we didn't get the pod in the future. Not only did we smash through the potential demand that we're close beneath, and that's really bearish. Then we've got another little pod down here. And the other thing you'll find is that past pods should be future pods, but past pods can also act as future POSs. Okay, I know you're going to have to go back to the recording. I'll put that on YouTube later on. You have to listen to that a few times. Past pods tend to be future pods, but past pods can also be future POSs. And we can see here that with these points of supply now falling, being lower in relative terms with the price, really that speaks to, and there's only one way that can happen when you think about it. We've got building supply in the market. We've got basically we've got an excess of supply. Okay, supply is overwhelming demand, especially when we put together the fact that we are now really taking out our pods. What does that mean? What does that mean for demand? What does it mean for demand? Is demand getting stronger? Is demand getting weaker? I'm going to say we've got diminishing demand, don't we? So if you've got building supply diminishing demand, do you really want to be in the market? You can see obviously the trends are changing, short-term trends going to downtrend, and then we're seeing how the long-term trend does tend to support. Here's the other thing: we've got dynamic support through here. So you find that these zones, these value zones, as I call them, when there's a nice short-term trend established, we find that the price tends to come back to those zones and tends to bounce off that zone, okay? And it works also for the long-term trend zone. We sort of come here, bounce off. The big problem is when you fail at the long-term trend zone and then you sort of retest it and fail again, that's not good. But anyway, we're probably getting a little bit off topic here, as I was talking about the NASADAQ. And you see lower peaks, lower troughs, great indication something's not right. And then head back the other way, you can see how things just reverse around. You just take everything I say or just said and turn it upside down. And now we've got building demand, don't we? We've got a pod here. We've got our pod here. We've got our POS here, okay? And then we end up with another POS up here. But really, it's at this point here. This is the key point right here, because this is the point, or above this point, we've taken out that POS. So we knew we already had building pods in the system, but we've taken out that POS. So after this point here, we're guaranteed to have higher peaks, and we've already got higher troughs. We can see that the short-term trend goes through the traffic light system, then goes green, and the long-term trend goes back to green again. And look, I don't actually think we've wasted any time here, because guess where we are right now? We're in a market. Look at this. Look at that. Look at that. And then look at this, did it again. Look, it just did it again. You've got to look at this and you go, well, why don't more people know about this? Hey, I'm here every Thursday, ladies and gentlemen. Look at that. So here's the other thing. So on the way down, you'll find that the dynamic zones tend to resist price movement to the upside and re-establish the trend. Okay, so there's one there, there's a big one there, there's one here, I would suggest. So what we really need when we're back to now. Okay, so we kind of seen what the NASDAQ needs to do to turn this bear market around. And there's some good stuff going on, 10.088, 10.027. You've got little peaks and troughs and you've got big peaks and troughs, don't you? Hopefully this has become evident as well. And, we could go on for a long time teaching you this stuff. But I don't have that sort of time in a 1 hour session, but kind of starting to see that look, demand is building, supply is starting to give way. So all is not lost, but we need to decide, don't we? We're at this key zone here where the market is being forced to decide. Do we want to continue with this fledgling rally, recovery, or are we about to reinforce this big time, crack beneath that, go to lower posses, lower pods, and then come down here and test that? I don't have the answer for you. But what I can say is that last night's candle is not a good one, and it would lead me to lean towards lower stock prices ahead on the NASDAQ rather than higher stock prices. Let's see what the candles give us tonight. Okay, I think I've done that one for you there, Damien, but if you've got any other questions on that, let me know. Let's have a look at the Uranium ETF for Angus. And look, again, I might not look at the Uranium ETF because this session's not about stuff you can buy on the NYSE or the ASX. This is about big picture macro. So let me answer your question, but in a different way. Let me go straight to the source, which is the uranium chart, okay? And I guess where I said before, if you want to trade gold, just buy gold. Very sensible. I can't really say, think about this for a second. I can't really say, hey, if you think uranium's going up, don't buy uranium stocks, just buy uranium. Okay, that's, unless you sort of Doc Emmett and Back to the Future, well, he bought plutonium, didn't he, from the terrorists, the Palestinian terrorists. You can't really do that. Okay, so you are probably going to have to trade an ETF, but let me put to you the ETF is probably going to do something along the lines of what's on screen, which is the spot uranium price, which is very flat at the moment. Let's do the analysis. What sort of trends do we have? Well, do have a long-term uptrend. It's not very strong though. Here's the other thing about the trends. The steeper they are, the stronger the trend. The greater the imbalance between demand and supply in the market, skewed obviously towards excess demand. As they flatten out, something must be happening inside that balance. And what's happening is supply is coming into the market. So we go, oh, well, clearly here, let's do it a quick way, excess demand. I also would tend to call this a demand side market. Okay, and then we start to get a little bit of supply coming in, the lower peaks, lower troughs, of course, but we're moving more into what is an equilibrium market. I lost my caps, doesn't matter, market. And it's still equilibrium. It's still sort of equilibrium through here. Nothing's really changed. And, we've got big question marks over where we go next. And we just need to wait for cues from the market. So there's not a whole lot of technical analysis I can do on this, except to say, hey, the balance between demand and supply, there is balance between demand and supply, therefore prices are going sideways. And I'd be looking very carefully at a move outside of this sort of range to indicate to me one of those sides is taking over again, and therefore we are potentially going to move back into a period of excess demand back here, or the market will signal to us that no, supply has taken over. Actually, it could be supply if we're down here. So if we're down here, supply has increased, okay? Or think about this possibility. Supply is exactly the same. So it's not like there's more sellers of uranium out there. They're just more motivated to exit. Same amount of supply, more motivated to exit. Or down here, demand ran away, all right? And that spooked the supply, made them more motivated to exit. And we can do the opposite up here. If we can break out of this range, then a demand is becoming more motivated, isn't it? That's the only way you can get up here. Or supply has run away, and that's making demand more motivated. Because you need this stuff. If you're a big, French nuclear power plant, and then all of a sudden there's no supply of uranium, well, guess what you need to do? You need to be more motivated with your demand. Okay, and that would be good stuff for the ATOM, which is the ETF. And I wonder if I'm going to find it. Let me see if I can find it. There it is. Yes, ATOM. Atomera, is that it? I don't know. Anyway, we saw the uranium chart. Okay, let's keep moving, and we're going to do Bitcoin for Hanelli, which is one of my favorite assets. So let's head over. Where am I going to go? I think I'm going to go here, and we're going to go to Bitcoin, which is obviously in a different watch list here, and down to here. And I was about to say let's zoom in, but let us not zoom in for a second. Let's check those trends. So we've got a checklist. Let's check our long-term trend. What is the long-term trend? It's neutral. So you can see traffic light system amber. If I sort of scroll back for you, you can see again how the traffic light system was once again very, very good at predicting that things went right. Things really went right. Things were really not right at all. But the good news is, it's equal and opposites, isn't it? That's how it changed to the downside. This is how it can potentially change back to the upside. So right now, I'm pretty happy with the way this is going. The other thing that makes me happy about the way this is going is the fact that it has stopped. Being an area. So that long-term trend zone has stopped being an area where we have observed dynamic, I call it dynamic resistance, okay, or dynamic supply, okay? And I'm not as good at drawing on this one as the other one, but bear with me. So we've gone to actually starting to offer dynamic support, okay? And it's not always, this is not an exact science. Sometimes that demand there, I should say, is a little bit spongy, okay? But it appears to be offering that dynamic support. It appears to be turning around, and the short-term trend appears to also be up and supporting price. Well, we actually haven't had a first test of that just yet, but we may well get one very soon. So that gets me to where we are now, and you can see some of the drawings we've done in the past where we talked about points of supply, and we obviously broke through those points of supply. It's actually, this is really interesting. So you saw obviously the demand side candles, you saw this potential transition candle, and the supply that came in here really had no legs, did it? In fact, that supply was evaporated very quickly through here. So that's a good sign. When you take out these shadows, that is a super bullish signal. So you take out that shadow, all right? That is a major point of ex post regret. So if you can imagine in this candle, and if you're trading Bitcoin, you know how this feels. Bitcoin's going up, right? And just imagine how many. I shouldn't generalize. This is not fair. I'm going to say this, and then I'm going to withdraw it. Okay, so it's about to be taken off the record. But just imagine how many young kids in hoodies in their parents' basements trading Bitcoin, watching it on the 5-minute chart with this giant white candle going, and they're itching to buy it, right? They're itching to buy it. Oh, no, it's got up too much. I can't buy it now. Oh, no, should I buy it? I should have bought it. Why didn't I buy it? Oh, no, I'll buy it now. No, I won't. Oh, no, it's going up again. Oh, bang, buy. All right. It doesn't have to be a teenager in their parents' basement. I know we've all done it, haven't we? We've all bought right here. Okay. And then look where it finished. How are those individuals feeling at the end of that session? They go, no, I shouldn't have bought it. I bought it at the top. Why did I buy at the top? I always buy at the top. So it represents a really important point of what I call ex post regret after the fact. And now they're hoping, please God, if you just let Bitcoin go back up to 26,534, where I got in right at the top, I promise I'll get out of Bitcoin and I'll never trade crypto again. So there's a bunch of latent supply up here. Okay, I say latent as in it's there potentially. Okay, it's contingent supply, contingent on the price getting back up there, people breaking even, undoing their mistakes. And not everybody's going to feel like that, but some will. And if we can take that supply out, what does it say about the demand that's in the market? Okay, they're just steamrolling through. Look, I think this is fine. Last night's candle is not great though. So if I had it, would I sell some purely based on last night's candle? I wish last night's candle was far more decisive, so I could say yes, absolutely. And if this closed on its low, I would say absolutely yes. you should exit some of your Bitcoin holdings on the basis that you're probably going to get it back a bit cheaper. Where, and if you could be bothered playing the game of getting it back cheaper, probably somewhere in here, right, as this starts to come to the party a little bit more, and we're going to get something which probably resembles a first test of that short-term zone. So, something that, price action that could resemble that, okay? But last night's candle wasn't. There was a little bit of demand left in the system. Look, let me give you some numbers here, so I don't want to flip and flop around. So that low there is 26,672. Look, if we close beneath that, I think you can exit some with a view of maybe picking it back up. If that's your game, okay? If that's not your game and you're in for the long haul, no, there's nothing so sinister here that would suggest to me that you really have to, act aggressively to the downside, okay? Would I short it? No, I wouldn't short this thing, but that's not my style, okay? Some people look at that candle and say, this thing's guaranteed to go back to 25,000 and therefore I can make $1,000. And it's just not my style because it's fighting. You're choosing to fight this and you're choosing to fight this, and that's just not what I do. So I'd more likely just hang out of the market if I don't have any Bitcoin, and I'm going to wait to see what candles I get in this light green zone. So I've said this many, many times. I like to buy stuff when the long-term trend is at least not down, but looking like it's at least turning back up. The short-term trend is up, right? The price action's good, and the price action is good up to this point. And I'm buying it with good candles, demand side candles in and around my light green zone. So that's where I prefer to be buying some. If I don't have any, if I had it, I think I've given you a pretty clear view of what you might want to do. And if you're thinking of shorting it, then for me, I'm taking that off the table. Okay. I think I've covered all the scenarios there on Bitcoin. For Barry, let's do Cardano, which I can probably do pretty quickly because it's not as good as Bitcoin. Not awful though. Hey, this is pretty good, Barry. Barry knows that I do own Cardano. I've been hodling it for a very long time, but I like that candle. That's a ripper. And what it does, I think, between that candle and that low there, gives us a really good line in the sand. Okay, Barry. So I'll call you, you call me, and let us hold hands, Barry, and let us agree, okay, that we are no longer going to take the abuse that we've so long been accustomed to. Cardano. We are Thelma and Louise style, Barry, you and me. If Cardano trades back beneath, and let me give you this this low here. So that low there is 0.2979. Stopped even looking at the first two digits of my Cardano hodling. But Barry, you and I, we will get out of Cardano and agree never to trade Cardano again. In the meantime, there's a bit of demand coming into this. Don't get too excited though, Barry, because there's plenty of supply around. How do I know there's plenty of supply around? Well, yeah, that's a big downtrend. It is impeding upward price movement. We've got a couple of little tops here, tweezer tops, if you want to call them that. Some people call them that. And there's short-term trends a bit ho-hum. I can go hold on the basis of what I can see with high alert coming if we break beneath, that close beneath that 30 level. Where would it become a buy? It needs to do so much, doesn't it, Barry? We need to see high peaks, high troughs. We need to see demand side candles. So let's just leave it at that. Let's just call that a hold for now. From Michael saying he was 10 minutes late. Not sure if I covered Bitcoin and Ethereum. Well, good timing. I'm guessing 10:33, it's now 10:43. So you must have seen the Bitcoin one. So let's head over to Ethereum now. And if I can find it in here, but it's alphabetical, it shouldn't be too hard to find. There we go, Ethereum. Looks similar to Bitcoin. Obviously, looks better than Cardano. Maybe not as good as Bitcoin. I think last night's candle is far more bearish and far more disturbing. And I think the price action in and around that 1850 is also quite disturbing in that the supply is manifesting itself in the system around that 1850. Higher, the upward shadow here, upward pointing shadow, not a bad candle here, but again, the shadow coming in and then last night wiping out. Closing a little off the lows like Bitcoin, so a modicum of demand left in the system, but really I think starting to look like we're going to get a vibration to the downside, which would more than likely target into this zone here. Let's hope that the uptrend, once tested, holds. Let's hope we see some of those shadows pointing down, the white candles in there, and that Ethereum can make something of this changing long-term trend. I do own some Ethereum, I do own some Bitcoin, I do own some Cardano. So if I'm more comfortable with my Bitcoin and Ethereum holdings than my Cardano holding. I do only own a little bit of Cardano. I do own more Ethereum and more Bitcoin, relatively speaking. Barry saying Bitcoin basement. Bitcoin, what does that mean? Bitcoin basement bargain price? Possibly. Have I covered gold? I've covered the hell out of gold, Carlo. You have no idea how well I covered gold. Catch the recording. I haven't done lithium yet, so let's head over to lithium. Lithium is not something we can trade unless you want to go to Shanghai and on the Dalian Futures Exchange. I'm pretty sure there's a contract there you can trade. But for us mere mortals, let us have a look at the charts, and then you can draw from those charts your own conclusions. And I've got one I'm trying to find here. I'm filling time. Here we go. Lithium carbonate. So you can see that one continues to decline. Carlo, no respite there. It is a trend we have been monitoring, or at least a breaking trend that we've been monitoring for a very long time now, months now, that I've been telling you, be careful with your lithium companies, ladies and gentlemen, because these trends are changing. Traffic light system, they're just so consistent to the downside. And no, there is no bounce. I mean, we've gone from 580 down to 240, and this thing hasn't blinked yet. In terms of the lithium hydroxide price, now that one I do have here. So let me head back and find that for you. And that is LITH, there we go. And that is also starting to cool over. So now you can take lithium carbonate and do a bunch of stuff with it. You can process it into lithium hydroxide. I'm not a chemist, but this is my understanding of how it works. And now lithium carbonate is the stuff you get from your lithium brines, or your brine salts, I should say. So typically your South American operations. So Allchem is an example of a company that is more exposed to the lithium carbonate. And then you've got your hard rock lithium, which comes from Australia. Typically, Australia has massive deposits and massive production. And there's a lithium mineral called spodumene. Okay, and it's the spodumene which you then process. A couple of big processing plants just south of me here in Perth, in a industrial suburb called Kwinana, and you process it. Wesfarmers is doing this. I'm pretty sure IGO is doing this, and MinRes is doing this, and you get your lithium hydroxide. So because more stuff needs to be done to the stuff you dig out of the ground to get your lithium hydroxide, it tends to hold up better than your lithium carbonate, which is pretty much you dig it out of your salt lake, you put it on a truck, and you send it to China. Okay, so that's why the lithium carbonate prices are tanking, and there are a few big players in the Chinese market that are just offering discount after discount after discount, maybe because they can see finally the supply that the world has been crying out for is coming online. So this is holding up better. We can see that. It's clear in the chart, and maybe it's not that clear, but you can see the lines. We don't have Japanese candlesticks here because we get a PM fix. We get one price for the day, indicative of what the transactions were on that day. And it is curling down. I don't know if you can see that, but certainly the moving average is a changing trend here. But there's a reason why it's holding up better than lithium carbonate. So it's more about a processing bottleneck, isn't it? Carlo asking for copper. Certainly we can do copper. Let's head up here. So I'm going to look for the next one up. Code is HG, and doing pretty well actually. I'm surprised that copper is holding up, given hashtag banking crisis, given that many industrial metals took a beating on that. So maybe speaking to some of copper's own demand supply dynamics. Looks okay. It's holding, isn't it? It's holding that long-term trend. The candles, 2, 4, 5 of them are white. I know there's an upper shadow on the fifth one back. Little transition candle there. So I'm talking about what's going on here. Well, it's not terrible. The short-term trend, though, is not convincing for me. If anything, if I'm a trend line drawer, and I'm not a trend line drawer, by the way, I don't do trend lines, but that's clearly there. Yeah, look, there's a bit of supply. You can see the shadow here. It's a bit ho-hum. Look, we are being compressed, aren't we, within a range? And if you believe, again, those traditional technical analysis books, we could see a break this way or we could see a break that way. Yeah, so it's just a wait and see. There's nothing so sinister in there, however, to say that you know, the price of high-grade copper is about to crash. I don't think that at all. But there's similarly not enough in there to say, hey, this is about to go on a rampaging bull run. What would make it look better? Well, we'd obviously like to see higher peaks and troughs. So something that price action that looks like this, okay, in and around this area here, and those demand side buddies. If we start to see those, that sort of price action, and then we start to, you know, encroach and deal with clear points of supply here and here, then that would start to build actually a really nice base. It actually would be building a nice base if those things happen for a continued long-term uptrend in copper, which is, you know, trying to establish itself. I know that's sitting on the fence, but I can literally only sit on the fence that the chart gives me. Okay, I can't make stuff up here. Barry saying regarding Bitcoin basement, smiling at the basement, the kid in the basement. Yeah, I know. Hey, that's been everyone in this session, no doubt, watching something go up and having that crisis, isn't it, of should I buy it, knowing full well that as soon as you buy it, that's the top. But don't put yourself in that situation, is what I say. See, I think there's a lot to be said about trading on an end of day basis. Once the candle is fixed and finished, once the market's closed, you come in. I know Bitcoin doesn't close, but you know, come in at the end of the day, check it once. You got 5, 10, 15 minutes looking at the markets in total for the whole day, and you can't make those screw ups. You can't let the market get you. Okay, you just say that candle's white, that candle's black, that's the trend, that's the price action, here's my trade, boom, and that's it. Walk away and come back the next time you're scheduled to look at the market. The more you watch the market, the more you're going to trade. The more you watch the market, the more you're going to make emotional trades. And the more emotional trades you make, the worse your results are going to be. Detaching yourself from the live prices by default removes a great deal of those emotions, and therefore your trades get better. Okay, I think I've covered all of the various lists I have in front of me. Khan is saying, don't forget Carl is running multiple webinars. Yes, I am. I've got plenty of older webinars to review. This is in the chat window at YouTube. And I do have a bear market survival guide that I've written, which I think is extremely relevant at the current time. Let us, if there are no further questions, adjourn for the day, and to remind you that that's how you register. If you're watching me on any of the streaming services, you're welcome to join us live in session at www.thinkmarkets.com/au/webinar. I do an ASX session if you're trading ASX shares on Tuesdays at 1 p.m. Obviously today's session covering macro at 1 p.m. on Thursdays. And then tomorrow is actually my favorite session, where we get to look at the Teslas, the Facebooks, the Apples, the Netflixes, the Alphabets in the USA edition. Slight time change there, 12 p.m. Eastern time. If you're not a client of Think Markets, you really should be, because we are the good guys in the Australian broking market. We've got everything you need to trade for your self-managed super fund at a super low flat rate. Okay, none of those, oh, it's a bit cheaper if you trade up to $1,000 or $500 that you probably never trade anyway. Flat rate, $8, HIN and CHESS sponsored as well, so your shares are not pooled with everyone else's. We've got a bunch of CFD products to trade as well, like gold, like copper. You can trade copper as well. And I always say, hey, if you think a commodity's going up, where possible, buy the bloody commodity, not the commodity shares. Too many things can go wrong with them. Market leading spreads and commission free. And for me, the best thing about Think Markets is the last point there. Dedicated account manager, 24/7 customer support. We don't hide our phone number. We don't have automated AI powered chatbots. We've got real people that you can talk to and who can really get your problems sorted out. We are an award-winning broker. We have offices all over the world, and we are regulated heavily by many, many, many jurisdictions, ASIC, the one in London, the one in, where's the other one? You know what I mean. Look, Google it. We're regulated everywhere. thinkmarkets.com/au. We're regulated in South Africa. That's another one there. Where are we in the US, London, Japan? We're in Japan. I'm waiting for an invitation. We're in Thailand. We're in Vietnam, Philippines, all over the show. If you like what you're seeing, hit the subscribe button to stay notified of any future updates, and hit the like button to let me know that you like what I'm doing so I continue to do more of it. Apart from that, soon in New Zealand, says Khan. It's been a pleasure chatting with you today. All the best if you're trading and investing. Till we catch up again. Bye-bye for now. But don't forget that everything we've discussed today is general in nature, has not taken into account your personal financial circumstances or particular advice. So before making an investing decision based upon this general advice, you should consider it carefully or seek the help of a financial professional. You can learn more about Think Markets and all of our products by heading to the website and downloading our product disclosure guide, our PDS.